It's September 2007 in the United Kingdom. People are lined up outside a bank before it even opens, not because of a sale, not because of a holiday. They're trying to get their own money out before everyone else does. 16 years later, on the other side of the world, the same thing happens again, except this time, nobody has to leave their house. In less than 2 days, a major bank simply stops existing. So what actually happens when a bank run starts, and why does it spread so fast? To understand a bank run, you first have to understand a secret most people never think about. When you deposit money in a bank, that money doesn't just sit there waiting for you. The bank lends most of it out as mortgages, business loans, car loans, or invests it in things like government bonds. This is called fractional reserve banking, and it's not a flaw. It's literally how banking has worked for centuries. Banks make money by putting your money to work. The system works perfectly fine, as long as only a small number of people want their money back at the same time. The problem starts when everyone wants it back at once. This brings us to Northern Rock, a British bank, and the first bank in the UK to suffer a bank run in over 150 years. In September 2007, Northern Rock had a problem. It wasn't bad loans, and it wasn't reckless lending. It simply couldn't borrow enough short-term funding from other banks to keep its day-to-day operations running, because the wider lending markets had frozen up. So Northern Rock did the responsible thing. It asked the Bank of England for emergency support. That's when everything went wrong. The moment this request became public, ordinary depositors panicked. Not because anything had actually happened to their money yet, but because they were scared something might. On the very first day branches reopened, customers withdrew around £1 billion. That's about 5% of everything Northern Rock held, gone in a single day. By the following Monday, £2 billion had left the bank. This is the part most people misunderstand about bank runs. The panic itself can cause the very collapse everyone is afraid of. Northern Rock wasn't insolvent. It was a liquidity problem turned into a confidence problem, turned into an actual crisis. The run only stopped when the government stepped in and guaranteed all deposits in full. Within months, Northern Rock was taken into state ownership. Now fast forward to March 2023, and a very different kind of bank in a very different kind of crisis. Silicon Valley Bank, known as SVB, wasn't a bank for everyday people. It served startups, venture capital firms, and tech companies. Many of its customers held far more than the standard amount that's protected by deposit insurance. SVB had taken a large portion of its deposits and invested them in long-term government bonds, safe investments on paper. But there was a catch. When interest rates rise quickly, the market value of older, lower-interest bonds drops, and interest rates had just risen at one of the fastest paces in decades. On March 8, 2023, SVB announced it had sold a chunk of those bonds at a loss of $1.8 billion, and that it needed to raise even more money to stay stable. Here's where this story moves differently than Northern Rock. SVB's customers weren't ordinary depositors standing in line. They were startup founders and venture capitalists, a small, tightly connected group who talked to each other constantly, often in the same group chats. Within hours, that network was telling itself one thing: get your money out now. On March 9th alone, customers tried to pull around $42 billion, nearly a quarter of the bank's total deposits, in a single day. By March 10th, just 44 hours after that first announcement, regulators shut the bank down. It became the third largest bank failure in United States history. No physical lines, no queues outside branches, just phones, apps, and a network of people who all moved their money at the same time. So what actually stops a bank run before it destroys the entire financial system? In the United States, it's an agency called the FDIC. If your bank is FDIC insured, and almost all of them are, your deposits are protected up to $250,000 per person, per bank, automatically. No paperwork, no application. Since the FDIC was created in 1933, no insured depositor has ever lost a single dollar of covered money. But here's the catch that made SVB so vulnerable. Most of its customers were businesses holding far more than $250,000 in a single account. Most of their money technically wasn't insured at all. In the UK, a similar but separate system exists too, though in Northern Rock's case, the government chose to guarantee deposits in full, rather than rely only on standard insurance limits. When a bank run threatens to spread beyond one bank, regulators have one more tool: stepping in directly, guaranteeing deposits, or creating emergency lending programs so other banks don't face the same trap. That's exactly what happened after SVB. The Federal Reserve created a new lending program specifically, so other banks wouldn't be forced into the same fire sale of bonds that killed SVB in the first place. Here's the pattern worth remembering. Northern Rock took days to collapse, with people queuing in the street. SVB took less than 2 days, with no queues at all, just phones and group chats. The mechanism behind a bank run hasn't changed in centuries. Confidence breaks, and everyone tries to get out at once. What's changed is the speed. Money used to leave a bank one customer at a time, in person. Now it can leave in seconds from anywhere, the moment enough people lose confidence at the same moment. The system depends on something simple. Most people don't ask for their money back today. The instant that stops being true, even for a moment, everything downstream breaks. A bank doesn't fail because the money disappears. It fails because, for one critical moment, everyone needed it to be there at the same time. If you found this interesting, there's a lot more hiding behind the everyday systems we never question. Subscribe if you want to keep pulling that thread.